The new tax bill just increased the SALT cap from $10,000 up to $40,000, which will literally save individuals billions in taxes over the next few years. Plus, certain business owners and investors may be able to write off more than the limit actually allows them to, or in some cases double dip into this by electing to write off some of these expenses through their trade or business. So in this video, I am going to give you a very simple breakdown of these new rules so you know exactly how you may be able to benefit from this as a practicing CPA that works around these types of rules every day at mycpacoach.com. So if that sounds good to you, please hit the like button below, comment your thoughts as we go through this, and let's go ahead and dive right in. Okay, so let's add some context here first. Prior to the big beautiful bill passing, there was a lot of fuss around the SALT deduction altogether, which traditionally allowed people to write off their state and local taxes on their individual tax returns. This included almost every type of state and local tax you can think of, like state income tax, city and county income taxes, property taxes on real estate or vehicles, and even sales tax in some instances. And before the 2017 Tax Cuts and Jobs Act passed, there was one, no SALT cap, meaning that people could deduct 100% of these expenses on their taxes if they itemized, and two, there was no income limit. But what happened is that when the 2017 tax bill passed, it capped these deductions to just $10,000 for all taxpayers, which negatively impacted taxpayers in high tax states like New York, California, New Jersey, and so on. Because now all of a sudden they went from a world where they could write off 100% of these expenses to a world where they could only write off $10,000 of it, causing many of them to instantly owe more money in taxes simply depending on the state and city they lived in. So when it was time to pass the 2025 tax bill, there was a lot of debate around this single provision. And they have passed significant changes into law. So let's go ahead and walk through those new changes and ways that you may be able to use this to maximize your tax benefits. Okay, so starting in 2025, the SALT cap will be $40,000 for taxpayers with less than $500,000 in taxable income. But this is only for people who use the itemized deduction instead of the standard deduction on their tax return, which may not be beneficial for many taxpayers to do. Or two, people who do not earn above the income thresholds. The cap is reduced by 30% of the amount of income that exceeds that threshold. So someone with $600,000 in income will be limited to a $10,000 SALT deduction. Plus, even if you do qualify, for some taxpayers, this cap will still not be enough for them to write off 100% of their SALT expenses. So let's break down this even more and go over some strategies that you may be able to use to maximize your tax benefits, which starts with the decision to use the itemized deduction in the first place. So when you go and file your taxes, you have a choice to make, to either use the standard deduction or the itemized deduction on your tax return. You cannot use both. And for many taxpayers, the standard deduction is more beneficial for them than the itemized deduction because it has increased so much over the years. For example, for the 2025 tax year, it will allow single taxpayers to deduct almost $16,000, head of household filers to write off almost $24,000, and married filers to deduct about $31,500, which means that if your itemized deductions do not exceed these amounts, including the SALT stuff that we just talked about, then the standard deduction is still going to be more beneficial for you than itemizing. And to figure this out, just tally up all of your itemized deductions, like your medical and dental expenses that exceed 7.5% of your income, plus your state and local taxes up to $40,000 now, plus any mortgage interest expense that you may have paid. Also include any gifts you gave to charities, as well as any casualty and theft losses if you have any. Plus, there's also a line for other itemized deductions, which may allow you to add some additional expenses here for very specific circumstances that you should also account for if you qualify for those as well. But ultimately, if all of these expenses together do not exceed your standard deduction, then itemizing still may not be very beneficial for you. And some people may choose the standard deduction over the itemized deduction because they are able to actually write off some of their itemized expenses in other ways, like through their businesses or other investments. So let's make sure you're aware of those opportunities as well. Okay, so related to SALT, let's say that we are in a situation where either one, you have SALT expenses, but not enough to justify itemizing, Or 2, you have more than $40,000 in SALT expenses and you cannot write all of it off. Or 3, you have too much income to qualify for the SALT cap altogether. So what exactly can you do? Well, there's a workaround for this called PTET, which stands for Pass-Through Entity Tax. And it basically allows your business to write off your individual state income taxes as a legitimate business expense. And when you use this workaround, there is no income limit or cap to how much you can write off, like what we're seeing right now with the itemized deduction under the new bill. And this is because it is being written off as a business expense instead of an individual expense. For example, let's say you have a trade or business earning $100,000 in income, and you also personally have $30,000 in state income taxes and no other itemized expenses. Well, if you are married, you may benefit more from the $31,500 standard deduction than using the itemized deduction. So let's say we did that, but still want to write off those state tax expenses. Well, if you qualify for PTET, you would be able to write off that $30,000 in state income tax through your business, therefore reducing your business income to $70,000, which means you will report less of that income on your personal tax return. And then on top of that, you could still take the $31,500 standard deduction, reducing that $70,000 in remaining income even more down to $38,500 that will be reported on your tax return. But who actually qualifies for PTET? Let's break this down even more. First, you must have a pass-through business entity, like an S corporation or a partnership or an LLC that is taxed as either one of these options. Also, if you earn 1099 or self-employment income as an independent contractor, you may be eligible to form one of these pass-through entities in order for you to take advantage of this. Now, these entities file separate tax returns, but since they are pass-through entities, they do not pay federal income tax themselves. Instead, the income they report on their return passes through to the owner's personal tax returns. So when the business pays the owner's state taxes, it would reduce the amount of income that passes through to the individual owner on their respective tax return. Second big requirement is that your state must allow PTET elections. At the time of this video, more than 36 states allow you to elect this, and more are likely to follow suit. But each of those states have their own rules on how and when to make the election, sometimes with a separate form or sometimes during your tax filing. So if you are considering this, be sure to work closely with a CPA to make sure that you are following the correct procedures. But ultimately, if you are eligible, this workaround may allow your business to pay your individual state taxes and deduct those expenses so you pay less federal income tax while applying the state tax that it paid to your individual state tax return as well, so that you are not taxed twice. But even without this, millions of taxpayers will benefit from the SALT cap increase, which will allow them to write off more at tax time if they have enough itemized expenses to outweigh the standard deduction. In either case, it is a good idea to start tax planning now so that you can maximize your savings when filing time comes around. And if your CPA is not helping you with this, just go to mycpacoach.com to apply to work with my team today.